Greetings, and blessings abundantly, everyone. Welcome to the Abundance Universe podcast. Very excited to share some awesome information with you today. Today, I have a very special guest, my good friend, Miss Dana Goodman. Dana, welcome to the Abundance Universe podcast. How are you today?
I'm great. I'm so happy to be here. Super excited to share a lot of great information.
Absolutely. Well, just so everybody knows, Dana is an expert at a lot of things. She's a finance expert. She's a loan officer. She's a mortgage expert. She's an educator, and she's helping people get into their first home in a lot of cases. She's helping people understand the entire mortgage and finance game and what goes into the financial side of real estate. And today, as she mentioned, she's going to share an amazing presentation with us. It's going to be very informative and educational. And we want you all to engage and ask any questions you have down in the comment section. Let us know, and we may do another episode and answer those questions. But we wanted this session to be really informative. And most of all, I want you to meet Dana and get to know a lot about her and how awesome she is. So, Dana, without further ado, I'll pass it over to you.
Well, I'm going to go ahead and share my screen with you right now. And let me make sure this is good. Okay, so we're sharing my screen right now. There I am. My name is Dana Goodman, as I mentioned, and I am a mortgage loan officer. I lend in 50 states, and I've done a bunch of these not podcasts, but presentations. And last presentation I did, they said, "Why don't you tell us something about you, not just what you do, but about you?" So I made this slide. This slide is a little bit about me. Over on the left here, you see that's my 20-year-old daughter. She's going to be a senior in college next year. We were on vacation in Mexico last year, and we took that photo. Here's my dogs. As you can see, that's actually their bed. Very spoiled. And these are some of the things that I like, some of the things that are a part of my life. I'm very interested in yoga. I've been practicing yoga for about 10 years. It's really brought me the namaste. That's my dog coughing if you hear some hacking in the background. Part of what I do, what I love to do, is community outreach. And one of the things that I've worked with for a number of years was Homeboy Industries, which is an organization downtown that helps formerly incarcerated members get off the street, helps jobs. And I put about 10 of them into their first homes. It wasn't
awesome.
fast. Go ahead.
I said, that's awesome.
Yeah, so I work with a realtor who actually came up through the Homeboy system, got off the street, became a very successful realtor. And he and I have been doing presentations and putting graduates of the Homeboy program into their first houses. I also went to USC. I'm just going to give a plug here for going to college or vocational school. I know that this is not what this presentation is about, but I highly recommend it as a vehicle for you to become a successful real estate owner, a successful business owner, if you can take that time out of high school. And I'd love to come back and do another presentation about getting money for college or vocational school and why it's important.
Absolutely.
I do a lot of community outreach. I am a patron of the arts. I like all kinds. I was married to a painter, a fine art painter, for 12 years. I ran his business. Don't think if you're an artist that you don't have a business, because you do. We all have to kind of be in that mindset, even for creative people, for writers, for artists, for painters, for actors, for dancers. You have a business and you have an interest in your business, and being interested in your business is really part of your gaining a measure of financial literacy so that you can be secure in your future.
Absolutely. I talk to entrepreneurs all the time about the importance of having the creative side mixed with the business skills and the business acumen and the organization. And sometimes it's even more important, the business side, than having the talent, because it's kind of the foundation for everything. So I'm so glad that you're covering these topics. It's so essential for anybody that's listening to the podcast.
Yeah, it allows you the freedom to pursue, to grow your business. And if you're just performing and taking that money and putting it in your pocket, you're probably not running a business.
Right.
So this is just a definition of financial literacy. It's basically what we're going to talk about investing today. We're going to talk about real estate, but it really covers everything. Financial skills that are personal and that also that go towards your business. Nobody is born knowing how to do this stuff. Um, it can be taught. If you don't know, nobody knows how to do this, especially if you're in high school and you're moving to college. May not be something that you're familiar with. You may not have been taught. I know my parents didn't really talk to me about money when I was growing up. Did your parents?
Not a lot. It was a very, very basic level, but not an investing level. It was more about here's how you can save the money you have and put it away and make sure that you have some for later. But when the questions are asked, how do we make money? How do we get new money coming in? It's usually crickets. So there's just not a lot of information about it, and definitely didn't have a lot of dinner table conversations about making or saving money. It was usually about other things, and the conversation when it does come to the finances usually just around getting a great job, and then it kind of ends
Yeah,
there. So it's really
but
interesting. But
not how you're spending your money, how you're managing your money. I mean, I kind of went out into the world. We obviously knew my parents, probably just like your parents, were of the save mindset. It was
right,
also more affordable to live, so there was money you could save. You know what I
right.
mean? And now that's one of our challenges. I'm going to talk about that a little bit later, is being able to save in kind of this economy. Um, so my parents didn't really talk about that, and they also didn't talk about how to responsibly use credit. Um, at that time, you didn't need credit as much as you need it now, just for a living. And it was not very good with credit cards when I first got one in college, because I just didn't know how to use it or what it meant or how it impacted me. So we're going to talk about that a little bit. I'm going to talk about credit first. I'm going to mix some of this with some home buying information, real estate information. And so it's going to be an amalgamation of just sort of a financial literacy mindset. And also, I am going to talk about real estate because that's what we're here for, right? Okay, so I wanted to talk about the credit bureaus. I don't know if you know this, but the bureaus are independent agencies that collect information about you. Have fun. Um, and with that information, some of the information that they collect, they amalgamate into a score, which we call a FICO score, which we're going to talk about in a little bit. But the credit bureaus came about because back when the country was forming, local merchants had to maintain a list of people who weren't paying their bills, right? Because maybe you didn't have the cash, you were a farmer, and you got something on credit. And so some of the earliest sort of credit bureaus were local merchants who were talking to each other about who was paying their bills and who wasn't paying their bills. And now, obviously, that's turned in. You can see the history of when these credit unions were formed. I remember it used to be called TRW, now it's called TransUnion. There are 3 bureaus, and they process about 1 billion points of data every single month on 1 billion credit cards in the United States. Not just credit cards, other kinds of trade lines like student loans, judgments, bankruptcies. They keep track of it all. So that's kind of a little bit of a history of how the credit unions came into being. We're talking a little bit about this, about what kind of information they maintain about you. And so they have everything that is like your current and past credit accounts. I don't know if you know this, but when you have a credit card, they'll keep the record of your payments for 7 years on that credit card. It'll go 7 years back. If you have a single 30-day late payment on a credit card, it can drop your FICO score about 30 or 60 points. So they will keep that. That will impact you for 7 years, single late payment. They will keep track of payment history, negative information such as bankruptcy or default, like default on student loans or other kinds of debt. And they also keep a record of who has accessed your credit information. As a lender, you give us permission. You should be asked for permission to pull your credit. We will pull credit from all 3 of these bureaus, and we will use the middle score to qualify you for your loan. Credit bureaus are now selling information. You can actually go and opt out having your information sold, but a lot of credit bureaus, especially Experian, will package your information and sell it to people who will buy it unless you opt out. People who will buy it are people that, for example, when you get your credit pulled on a mortgage, they may sell that information to other mortgage companies. So you may find yourself getting phone calls. Or if you apply for a credit card, you may find yourself getting phone calls or emails from other competing offers. And they are permitted to do this unless you go and opt out. If you type in Experian opt out, they will take you to the website. It does take about 90 days to take effect so that you're not getting those phone calls.
Okay, so it's basically like a do not call list that you can submit
Yes.
to the credit bureaus. That's
Yes.
interesting. Could you also talk real quick about the value of having a credit freeze or not? Because I actually had a credit freeze on my credit and recently had to take it off to apply for a new credit card. And they let me know, oh, we couldn't check your credit because you have a freeze on TransUnion, but you removed the other one. So you got to go back to TransUnion and remove the freeze. But could you talk for a minute about credit freezing and why someone might do that?
So a credit freeze is done if you suspect someone has that you are having identity theft, or you're concerned about information being released. And you can call one of these three bureaus. I just pulled this back up so you can see the three bureaus, and freeze access to your credit report. For a mortgage, we need two scores that report, but because sometimes they're slightly different scores, I would ask someone to unfreeze it so that I could pull the third score.
Mm-hmm.
And that we would get the best of three rather than the best of two. It gives you an extra chance to get a higher score. So you might freeze it if you're think that you're identity theft, but you should definitely unfreeze it at some point in time. You shouldn't leave it frozen indefinitely. Also, when you freeze your score, you basically omit that bureau's score for you. So anything that's reporting to that bureau will not report. So what that means for you is you may not be getting the whole picture. To apply for a mortgage loan, your frozen credit line, if you typically has to be unfrozen, because it will impact the score. If it's frozen, nothing is going to impact the score. Sometimes we unfreeze it and we see, oh, now those late payments are going to impact. So the reason that you do it is to protect people from accessing your information. There should generally be no reason to freeze your credit score unless you're absolutely sure of it. If you think you're the victim of identity theft, there's a process that you go through. You need to report to all three bureaus, and they will freeze it for a period of time. Equifax is very transparent with consumers. They have a fantastic website. If you want to go to it, you can find all about what to do with identity theft. Very user-friendly.
Awesome. Thank you for touching on that real quick.
Let's talk about FICO score for a minute. If you don't know what one is, it's the bureaus each have their own FICO score, and it's an analytic of your these things that we're looking at right now. Your amounts owed, your payment history. This is the percentage that it impacts your score. The new credit history, and credit mix. Credit mix means a combination of what we call installment loans and revolving credit. So an installment loan is a loan that you're going to pay off in a certain amount of time, right? Like a car loan. That's an installment loan. It has very little clout. So if you only have an installment loan, that's probably why your FICO is a little bit low, because the bureaus cannot see a payment history like revolving debt. Revolving debt is when you're given a balance and you don't want to exceed that balance. So it's very important to have a mix of both installment and revolving. Installment debt is also student loans or anything that you're paying off the same amount every month for a certain period of time until it's all paid off. A revolving credit card, like a Macy's card, is where they give you a credit limit of $3,000, and you go and you shop and you pay it off, and then you shop and then you pay it off, and you're either carrying some of that debt from month to month or you're paying it off. And that is how they can get this one over here, which is payment history. The most important thing you can do for your credit is to make your payments on time. I have seen credit drop 60 points for missing a $25 payment to Macy's. One 30-day late to Macy's. Now you do have 30 days. So from the time if your bill is due on the 5th, you have till the 5th of the next month to pay it. But I have seen people let their credit destroy their credit for very small amounts of money. And I ask people to kind of do a personal audit and say, if you don't have $25, then you should not be shopping on that credit, right? It's really painful. It's almost worse than having a catastrophic event because that late payment will be on there for 7 years. You can hire someone at your cost from a credit repair agency to go back. The way that they try to get that removed is they dispute it. And they're very good at that. And sometimes you can get that removed, but that could cost you thousands of dollars when you really only had to make that $25 payment. So payment history, I think that's the most important thing. The second most important thing to me is amount owed. Okay. If you are given a credit line of $3,000, you should not have a $2,995 balance. Because if you have that, you've run your credit line up all the way. That will be very painful on your FICO. You should be no more than 2/3 of the available credit. So, for example, if you have $1,000 credit line, you really shouldn't spend more than $666, right? Just 2/3. So just keep that. Make sure you don't go all the way to the top of your credit line. A lot of people do. It's common. And what happens is it destroys your FICO. I mean, you can get it back. That's the good thing about a FICO is in 30 days, as long as you don't have a derogatory like a late payment, you can correct it. And we can actually correct it when you're looking for a mortgage. There are some things we can do. We're not credit repair people, but we can run a worksheet and see what we could do to pay off to get a slightly higher FICO.
And what are some tips you have for somebody that maybe they did have some situations happen, they let some payments get behind, and they're working to get their credit score up because maybe they do want to purchase a home or get a mortgage? What are some activities that we can do in addition to, of course, paying on time? What can someone do to get their credit score up quicker other than just making sure everything's paid?
There's some ideas. One is to pay down the existing. If you have other cards, continue to pay them on time, including the derogatory. Try to pay them off as quickly as you can. Try to maintain less than 2/3 of the available balance. Your credit score may be so low that you may not be able to get any more credit to build credit. That's kind of an issue with people. Sometimes a lot of people that I work with at Homeboy have very low credit because they've either been incarcerated or not using the credit system. So what we recommend typically is to get a secured card to establish new credit. A secured card is a kind of credit card that requires a deposit. You make a deposit, it will report to the bureaus so that you will start anew. It does not require a cosigner. It's very basic. But if you get a secured card, you have to use it. So I recommend people go out, they buy a tank of gas every month on their secured card and pay it off the next month. You are trying to show the bureau, you are trying to establish your reliability in being able to pay this off. And once you have a secured card for a while, you can go into your bank and ask them if they can convert it to a regular credit card. Both Discover and Capital One offer secured cards. You just have to Google them, and they will. You can apply for one. I think some of them require a very small deposit. They are very worthwhile, legitimate credit cards that will help you rebuild your credit. The other thing, if you have no credit, a secured card is great. If you have no credit and you're a student, you can get something called a student credit card. It's especially important for young people who just don't have experience with credit. Does not have, you can see some of the qualifications there, does not have a deposit required. You do have to have some sort of income, a job. It's great. Most banks will offer it. Bank of America has one, Chase has one, Discover has one, Capital One has one. They have different kind of perks than the secured card, but it's great for kids who are enrolled in school. So that's, a couple that you can do to rebuild your credit, continue to work your credit, and then over time you will improve it. And we can talk about FICO. It does not require a particularly high FICO score to purchase a home. but the better your score, the better your rate will be.
Right.
Lower score to a lender, or it's very automated now, so there's not really a lot of subjectivity in lending. We don't lend because we like someone. It's an algorithm. It's run by the computer, and we, as loan officers, we work on structuring loans to make them look really great so that we can get that approval. But it just shows the lender that you have responsible use of credit. It's just so highly important. We could do an entire presentation on credit. And especially if you're starting out, if you're a young person, especially if you're an artist, you may have thought of a cash and kind of carry situation. And that's really, you really need to establish credit is so important. It's not just important for financial health, but these days you need it to get an apartment. You need it for certain jobs. My job, they pull my credit every quarter to make sure that I walk the walk.
Right.
And some jobs will require it just to see that you don't have any outstanding, whatever. So a lot of people experience periods of where they have derogatory credit. I've had that myself, where I wasn't making a lot of money. I mean, I think we've all been there. And the good thing about credit is that it can change. It doesn't have, it won't stay that way forever, as long as you adapt new habits. I'm going to talk about habits. It's not really a skill, honestly. It's a habit. Paying your bills is a habit. And it's a habit that's very important for your financial health.
Absolutely. Well, yeah, let's get into it. This is exciting.
Yeah. So credits, if you have any questions about credit, we can do another it's actually a whole other presentation on credit and how to establish credit, but this is a good way to work on credit. Please forgive yourself for whatever past wrongdoings on your credit. It can improve. It will improve. And I have worked with hundreds of people who have gone from, sub 600 to over 700, based on following a program. It might take 6 months, but you can get there. I want to mention one more thing. You can also become an authorized user on someone else's account. As long as that person also maintains good credit, they will share some of their credit with you, and their account, their credit becomes your credit. Authorized user is a great way for people who don't have any credit at all to go with a parent or an uncle or an aunt who's responsible and become an authorized user on their card. Use the card responsibly. Any of these solutions will not work if you do not use this responsibly. You get a secured card and you don't make your payments, or you get a student card, regular card, and you don't make your payments. It's just going to be back to where you were.
Right.
So let's talk a little bit about real estate, because we're going to just kind of jump into that now. We're talking about credit because it is so important, but I wanted to see if you know the answers to these. So, oops, sorry about that.
Okay, so we got some true or false trivia here.
True or false trivia. Bijan, I'm going to see if you, now I can't see this. Let me see where I can move this. Oops, sorry. Okay. Wait, I'm getting rid of my whole thing. Sorry about that. Okay. I can't read number one because my toolbar's in the way, but what does it say?
Number one says you need excellent credit to purchase a home. True or false?
Okay, I'm going to ask you that.
Okay.
What do you think?
I think that's false.
I think that's true. You're right. That is false.
Yes.
You do not need excellent credit to purchase a home. You need reasonably good credit. You want to take a guess of what a reasonably good FICO score is? I mean, a decent FICO score to buy a house.
I would say like 650.
20.
620.
Yeah, you can go down to 620. You're probably not going to get the best rate. And you may have to show a little bit more reserve sometimes to get that, but 620 is where we're at right now. Some lenders will go to 500. I just don't recommend it. I would rather get your credit score up and go with a 620 is the minimum.
Okay.
Okay, next one.
Next one says purchasing a home is cheaper than renting. Let's see. I think that might be false. Starting out, I think a actual home purchase is going to cost a little bit more than just paying rent. Um,
Yes.
just my notion.
Yes, you're right. So it used to be that if we were all living in the middle of the country and houses were $130,000, then we probably would be less than renting, but it really isn't less than renting. It has some other costs that are built into it besides principal and interest, which we're going to talk about in a little while. So, yeah, it's not cheaper than renting.
Okay. Let's see. The next question says, I can purchase an investment property for the same terms as a primary residence. Low down payment, low interest rate. I think that's true. I think we could get an investment property on similar terms, maybe not the same price, but same terms.
That's actually false. You
Okay.
cannot. Investment properties have way deeper, way more, I guess, harder terms than most people say. It's harder to get an investment property. Occupancy is a big deal with lenders. We're going to talk about that later. It's your intent. What your intent is when you want to buy. I'll give you some ideas about purchasing an owner occupied or primary residence with an investment component. But investment properties are higher rates, significantly more down payment, and reserves.
Okay.
Reserves are savings that you have to show a certain amount of savings in your bank account at the time of closing that you can so that you can properly manage an investment property. We're going to talk about that in a minute.
And is that required for a residential as well? Do you have to have reserves or?
No,
Okay.
most of the time, no. Sometimes if you have very low credit, the findings will come back and say loan quality would be strengthened by reserves. So sometimes you have a 401k or something. It's not often, but occasionally, again, these loans are underwritten by an automated underwriting system. And then the loan officer's job is to make sure everything is structured correctly. So, what was what was I saying?
We're talking about the terms.
Yeah, the terms are going to be different for investment. We're going to talk about that in a minute. I'm going to show you what the terms are for investment and
Okay.
how to work around it too.
Okay, cool. And I see the next one. It says there are down payment assistance programs for primary residents.
Yes,
I think that's true.
it is true. Yeah, we
Yeah.
work with a couple of them. We can finance the down payment. Some of them can allow for closing costs. We can talk about that. That's kind of a future presentation, but there are programs available to help first-time home buyers because a lot of times that big chunky down payment is hard for people. That's the hardest thing to come up with.
Right. Now, what if I was a first time home buyer, but I want to buy something like like a 4 unit property, which
Yeah.
is
So
considered
if you were
residential, but still an investment property? How would that work with the down payment
no
assistance
DPA for units.
for
So if you're
any?
going to have anything more than one unit owner occupied, you cannot use the down payment. You
Okay.
can get better terms if you live in one of the units, right? So if you live in a unit, there's a couple special programs, not down payment assistance, but to allow you to have an investment component to your property. They are stricter and harder. And by the way, this is across the board. I know a lot of people don't know this, but all the banks for these kinds of loans, we all sell our loans to Fannie Mae or Freddie Mac, who are big agencies who buy loans. We call them the agencies. They write the guidelines, and so you will not get variation from guidelines from bank to bank, right? My bank is just the same as Wells Fargo. We underwrite the loans the same way. We use the same calculations for income, and we follow the same guidelines. There are ways to be able to buy a 4 unit and live in one unit and rent the others. We'll talk about it in a minute.
Okay. The next one says poor credit is the number one factor preventing home ownership. Maybe that's true. I don't know.
Yeah, it's not true.
Okay. Yeah, I would think maybe just like income would be the number
Income.
one. Yeah.
Yeah, especially for sometimes, but especially when I'm working with entrepreneurs or creatives, they need a little time to plan because income stability is very important in home buying for a self-employed person, and whether it's an artist or an entrepreneur. I'm going to talk about this, how we calculate the income. we usually use a 2-year average. And sometimes that, if you're working with someone that's self-employed, they like to write everything off. So their net income is not very much. So income can be a very big factor, especially with rising, rising rates, very low inventory, especially in Southern California. I lend in 50 states, but Southern California is very hard right now because we don't have any inventory. So it's really a combination of factors, but poor credit, I would say, is bottom of the list.
Okay. So we just need to have that investment capital to be able to put forth. And if there are other factors in place and reserves and things like that, credit may not be as big a factor or
I
preventative.
don't think it is. I think income is a bigger factor.
Okay. Income, then that's a number one factor is
Yeah,
income. Okay.
income.
Okay. So the next question I'm checking out here says there is a housing bubble right now and it will pop, prices or rates will drop. I think that's false.
You would be right. What happens in our microcosm of Southern California is when the rates drop, there's a frenzy to buy. And what will happen is the prices will go up when the rates will drop. If the prices go down and the rates stay high, there will still be a frenzy. And in Southern California right now, there are only about 12,000 listings on the NMLS, which is the real estate listing service. I'm not a real estate agent, by the way, but I work with them. I know a lot about them. We sort of, work together, but that's not very many houses. 12,000 properties for listing in Southern California. That is just not. There are a lot of people who need homes. There's a housing shortage. I'll give you an example. Burbank, the city of Burbank, they have 60,000 people that commute into Burbank every single day to work in the motion picture and television industry, and they have nowhere to live. So they have to come from other cities. I don't know if you've been in Burbank at 5 o'clock on rush hour, but that's why it's like that, because you have 60,000 people driving in. So it's an inverse relationship. When rates drop, prices go up. When prices drop, sometimes rates will go up to try to slow down the economy. That's why rates are going up now. But we still have a lot of competition. Actually, now is a great time to buy, because even if we have to get a higher rate to get into a property, we have less competition right now. So if you have a higher rate for 24 months and then we can refinance into a lower rate, you date the rate, you marry the house. So there are solutions for that.
Okay. All right. So the next one, I need 20% down to purchase a home. I think that's false.
False. Yeah. Minimum is 3% down. So
Yeah.
depending on the program, that is an owner occupied home, not an investment property.
Okay. Is there a minimum requirement for an investment property if you're doing a
Yes,
traditional
it's
loan?
20. It's minimum 20% down and other restrictive factors.
Okay.
So one agency, Freddie Mac, is 20% down. Fannie Mae is 25% down, and you may have to show landlord experience. There's a bunch of things. We're going to talk about it. And we're going to talk about what the solution is for this, because I have a solution for this. People who want to invest in real estate.
Let's go. There's always a way. Where there is a will, there's a way. And when you have great mentors who are educated like Dana, there's always a way.
Thank
Awesome.
you.
All right. So let's see the last question. It says a mortgage payment is made up of principal and interest. I think that's false because there's also some taxes, some insurance. There's some other feature factors that we have to consider.
Yeah, we're going to talk about that. I'm going to tell you what makes up a mortgage payment. And so, as we get a little bit closer, we continue talking about this. I will share with you. So here it is. This is sort of the difficulty in qualifying for a mortgage: uncertain income, low credit score. I would not agree with. I don't agree with this graph. I actually think too much debt is the next one. We operate on a monthly income premise. So all your monthly income, all your monthly debt, including the mortgage, taxes, and insurance, can be no more than at 50 to 56% of your income. And that would be gross income as a W-2 employee and net income as a self-employment. So I'm going to say too much debt. If you have a big old car payment, we're going to talk about that in a minute, that's going to take up a lot of your purchase power. That's going to reduce it. We look at everything on a monthly level, not on a yearly level, and not on a balance level. So we're going to include all your liabilities in your monthly debt. You might have a $40,000 student loan, but you're only making a payment of $58. That's all we care about. We care about the monthly, not the what we call the aggregate or total debt.
Got it. So you'll look at, if I want to come in and get a mortgage with you, you're going to say, what is your monthly income and what is your monthly expenses? And that's what's going to be used to qualify that.
And now, we're going to talk more specifically about what constitutes debt, what constitutes income in a minute.
Okay.
Lack of financial knowledge. This is why we're getting educated about this. Do not know the first step. The first step is to get pre-qualified. That's always what you should do to see what you can afford up front, because we'll tell you right away and we'll actually get that approval right away so that when you go out and shopping, you can shop with confidence. I'm not going to talk too much about the pre-qualification and the house buying process. That's another, I'm just going to talk about preparing to buy real estate. We're going to talk about that in another presentation.
Awesome.
So let's just start with what constitutes as debt. You can look at some of these things. When we say debt, we mean what's coming up on your credit report. Okay. The only exception for that would be maybe if you like alimony. If you're paying alimony, then you need to disclose that. Alimony does not, or child support do not always show up on your credit report unless they're obligated by the county or some other government agency. So we do ask you, if you have that. And here are some things. What do you think? Do you think charge-offs? Now, when you have a charge-off, that means the vendor, the people that you borrowed the money from have charged that off on their books. Is a charge-off? Do you think charge-off counts as debt?
Does a charge-off count as debt?
Yeah, if you have something that's been charged off by the company, let's say Macy's, they charge it off and close the account. Do you still owe that?
I'm not sure. Do you?
Yes.
You still owe that? And then does that go away after 7 years, or does it stay? Do you owe it forever? Or?
Well, some loan programs like just straight Fannie Mae will ignore charge-offs, but other loan programs like the famous FHA, which we'll talk about maybe some other day, also a first-time homebuyers program, you may not have more than $2,000 worth of charge-offs or collections.
And if you do have that, you're either going to need to pay it off or pick another loan product, right?
Yeah, we're happy to see a payment arrangement. So if you have a charge-off and you need to readdress it, you can make a payment arrangement with a creditor. A lot of times, I recommend, sometimes they'll take like pennies on the dollar. A lot of times charge-offs and collections are sold to other companies that collect, try to collect from you, and they'll cut a deal with you. I don't recommend anybody paying off charge-offs or collections until I review their credit report to see what action we want to take. But charge-off is something that you still owe, even though the creditor has written it off on their books. What's another thing? What about deferred student loans? Do deferred student loans count as debt?
Yes.
Yes. So even if your student loan is deferred for 2 years, it is presumed during the life of your mortgage loan that you will come out of deferment. So we will ask you to go to your student loan website and get a payment plan, not a payment plan, but they give you these options. Like when you come out of deferment, you have an income-based payment, or you have, they give you a bunch of options. We just ask you to get one. You don't have to set it up or anything. You just have to show it that that's what your payment will be, so we can plug that in. A lot of people have student loans, and a lot of them are in deferment. So we'll either use a payment that you give us, or we'll add 1%. So if your student loan is $4,000, we'll put in a payment of $40, like a placeholder, because we know that you will eventually have to start paying that. I'm going to talk about legal judgments. So a legal judgment is something where someone sues you and wins. They're not counted as debt at the beginning of the loan, but if you buy a house and then you have the judgment is attached to everything you own, that judgment may become attached to your home. So if someone sues you for $10,000 and wins while you own your house, that judgment may attach to your house without any kind of notice.
Is there a way to protect from that? Like, should I be thinking about purchasing my primary residence in an LLC to protect myself from
You,
situations like that? Or
you,
how do you see people dealing with that for
well,
like
I
asset
mean,
protection?
yeah, don't get sued. So you can set up a payment plan for your judgment so that it won't impact, it will not attach to everything that you own. I'll tell you a story that I was working with a woman whose boyfriend came onto the title of the house to help her with a refinance. So he was on title, and while he was on title, he was sued for $1 million and he lost. And then later on, he got off of title because his girlfriend regained her financial stability. Well, guess what? Well, he owed that house could not get title insurance, could not be resold without paying that $1 million because he incurred the legal judgment while he was an owner. And so that's a story.
Should he have taken himself? Should he have taken himself off title while he was like in the court
Yes, while he
proceeding?
was being sued. Yes.
Yeah.
That's just part of it. Obviously, don't get sued. That's something, it's rare. It doesn't happen often, but yes, you could. There are ways to protect. You would have to consult with your lawyer. You have to be the personal guarantor of your house when you get a loan. But when you after you close a loan, you can vest what we call vest title in an LLC. If you want an LLC, you want to consult your lawyer, but doesn't necessarily mean that you cannot attach a judgment to the property. So we can talk about that another time. I mean, it is rare, but it does happen that a judgment attaches to every single thing you own at the time that you get that.
Okay.
Well, these are some things that count as debt. That includes loans that you co-sign. If you have a buddy and you co-sign the car for him, and he goes out and defaults on that car, that becomes your credit too.
Mm-hmm.
Loans that you co-sign for others, if that other person has paid their loan on time in a timely fashion for 12 months, we can omit that from your liabilities.
Okay.
So we want to kind of look a little bit about income. I know I told you that we would talk about this a little bit. All the monthly debt, including the mortgage, can be it's between 45 and 55% of your income, depending on the loan program. So that's a really good place for people to start because they can kind of gauge, they can kind of know. For a W-2 person, if you work a regular job, we just use your gross. If you're paid $54 an hour, we use $54 an hour for your income. If you are self-employed, typically we use a 2-year average of your net income. And I'm going to talk about what that looks like. Averaged over 2 years and divided by 24 months will give you a monthly income. The most important thing to take away is W-2 wage earners get gross, self-employed people get net. That's after your expenses. We can add back some non-cash deductions like depreciation on equipment and other like very random, obscure things that you probably don't deduct. But all your expenses, your materials, your wages, your insurance, all of that are considered hard expenses. So I'm going to show you a little form after we do this slide. Alimony, child support, disability, Social Security, those are all considered income. They each have their own, including public assistance is considered income. We will accept that. Section 8 is considered income. Any of that is considered income. There are some stipulations. I'm not going to get into the details, but those are income. Those are considered income. If you have a co-borrower or a non-occupant co-borrower, like your parent wants to help you, we will consider their income. So a non-occupant co-borrower does have to be responsible also like a co-signer on the loan, but they will not occupy the property with you.
But will they be liable if anything happens? They're still kind of like a co-signer. Okay.
Yes. So in real estate lending, we use the term people are jointly and severally owners and jointly and severally liable. So they jointly own 100% of the property and they're jointly liable for 100% of the property. So the person who is your co-borrower must be able to also, qualify together with you. All the debt is added up and all the income is added up, and we use the same ratios. And that person definitely will be on title and will also be on the loan. Those are two different things. Not everyone that's a titled owner must be on the loan, but everyone that's on a loan is a titled owner. Second jobs, I get asked about second jobs a lot because in our economy, a lot of people have big income second jobs. If you've been working a second job, in addition to your primary job, you need a 24-month history. That's 2 years. So let's say you worked in the daytime, you work for Bank of America, and on the weekends you do Uber. As long as you report it on your income tax, we will take a 2-year history, 2-year average of your Uber income and add it to your current income on your W-2 job. But that second job does require a 2-year history.
Now, are there other subsequent jobs that could be listed? Like if I have a fourth or a fifth job, could that be counted,
yes,
or only 2? Okay.
No, you can have as many jobs as you want. Secondary jobs must be seasoned for 2 years each
Got
job.
it.
So I've had people with 3 jobs. The main job is what is considered to be your primary income, is generally your W-2 full-time work, okay, 40 hours a week. Any other jobs that you work part-time must be seasoned 2 years. I do want to talk about part-time work. You can be part-time and still get a loan, but you have to have that job 2 years. And the reason is because part-time people sometimes work variable hours, sometimes 24 hours, sometimes 36 hours. We're going to average that generally 24 months if you've been doing it. There are some exceptions to that, sometimes minimum of a year for part-time income, but I'm not talking about any other job. But if you let's say a lot of people do not work 40 hours currently in our economy. Sometimes they work 36, 26, 30, 24, then we would take a 2-year average. There is an exception to that. If you're a nurse or in the medical profession, sometimes there's an allowance. If your boss says you work 38 hours every week of the year, then we will accept that. We wouldn't do the average. Sometimes nurses only work a 38-hour week full time, or they work but it's every single week. So I know that's confusing, but if you work part-time, yes, you can get a loan. We need a 2-year income in 2-year history. If you have a second job, any second job needs to be seasoned 2 years.
Okay. Well, that's good. I want to
show. Go ahead. Sorry. Do you have a question?
No, I just said that's good to know. This is really great information, and it's good to everybody kind of take inventory of their situation. And we have a lot of artists and entrepreneurs that listen to the podcast, but we also are open to sharing this information for anyone to use, no matter what your situation is. And I also think for anybody that is an artist or an entrepreneur, I think it's a good idea to have a W-2 job or something that can provide some constant sustainability and some stable income to show for something like this. If you did want to go with the traditional financing route to get property, you can show that 2-year history, even if it is part-time work and you're still working on your other venture. You could show that additional income and that stability. So I think it's a great idea for people to have a job, especially if it's in line with what you already do. If it's in your industry, if it's providing you with skills and a network to work on your own passion or entrepreneurial venture, then let's do it. Let's have that W-2. It only can help.
I agree with that. I will tell you that some cases of self-employed income, if you have been employed for 5 or more years in the same self-employment, then sometimes we can get a 1-year finding. So you wouldn't have to use 2 years. You could use the most recent year. A lot of times around tax time, I call people up and say, you've been in business for 5 years. If you file one good tax return this year, I can help you get into a house. And then next year, now filing a tax return means, that shows income, means maybe paying taxes. So we're going to talk about that in a minute, but there are cases where we can just use 1 year as long as you've been in business for 5 or more years, sometimes less, depending on your credit. So there are cases where we can use that. I'm going to go to the next slide, and we're going to talk a little bit more about self-employment. Most people this is a Schedule C on a 1040, from the 1040, this is a tax form that most, it's called a profit and loss. Most artists will use this. Sometimes it's called sole proprietorship. This is what people use who don't have a company. They don't have an LLC, an S Corp, a C Corp. They don't have an entity. Okay. They just file their income on their personal tax returns. This comes from one of my clients who does, she has a fruit packing business. So she brings in a crew of people and you can see they make very, very good yearly income. That's their gross receipts is $364,000. Now, if you look down on line 21, that's their profit, $21,000 after expenses. So what do you think we're going to be able to use to qualify them? What number?
The gross.
The net.
Oh, the net. Why? Oh, because it's self-employment.
Yes, this is self-employment. So
if this was her W-2 employees pay stub, then they could use that. But because
if we were just this person actually pays herself a wage. So in that case, which I recommend that you do, you can take a draw or a wage like a W-2 as a self-employed person. We were able to use her income, her wage income. But if she had not taken a wage for herself, then she would have been, we would consider her to have made $21,000 for that year. So the point that I want to make with this is that if you write down everything and you are self-employed on this schedule, then you will not get the opportunity to purchase because $21,000, we don't live in Ohio, where it's just not very much monthly income. 21,000 divided by 12, which is under 2,000 a month. It's going to be very hard to buy a house. Mm-hmm. So what I counsel is what we can do is a lot of times when we get closer to tax time, I'll say, give me a draft of your profit and loss, that you file, and I'll get an approval based on that draft. And then you can go ahead and file it. You can make a payment arrangement with the IRS to pay off any tax liability that you use. We'll use that as a liability. And it'll be a way that you can, because we need that tentative profit number to be higher to qualify.
Right.
I know we're kind of getting deep in the woods on some tax stuff, but this is typically what prevents entrepreneurs from purchasing because they have a big gross sale, right? Entrepreneurs, self-employed, creatives, but they only claim 21,000 taxes. And the reason is because nobody wants to pay any taxes. And I get that, but for your financial health in the future, and if you want to make investments, and if you want to leverage, you have to show some income. Which kind of brings me to my next slide, which is the IRS is not out to get you. I know everybody feels like the IRS is just so bad, and they're just, they just want to take your hard-earned money, and they're not. I have a lot of clients who actually work for the IRS. I have hosted IRS actually has a community outreach speaker who will come to talk to people. We're trying to soften their image. They have a lot of really great information on their website. I do encourage entrepreneurs to use a tax preparer, even if it's at H&R Block, so that the tax preparer can maximize your tax credits and not having to pay. But the IRS also has some great resources. There is a video, I can't see it, but it's a small business structure video you can watch. It's a workshop. They have different information. This is just from their website.
And this is on irs.gov. So anybody that's watching or listening, you can just go to irs.gov, search for where it says file businesses and self-employed up here. And then they got the small business and self-employed category. And then they have the video here, small business taxes. Let's check that out. If the IRS is making educational content, let's go ahead and get educated by the IRS on how to pay taxes properly. So
and you can see the different structures. We didn't talk about this, but the sole proprietorship, which is right here, this is what you would file. This would go with your personal tax returns. I want to make it very clear that this is a schedule on your personal tax returns, and that this line 21,000 will get carried over to your personal returns. This is one schedule on your personal returns. If you're a partnership, a corporation, or an S corporation, or an LLC, you wouldn't be a partnership. Partnerships are only for like lawyers and doctors. But you can look here on the IRS and see what these different business structures are, and you can find the best one for you. Most people start out as sole proprietorship, like this. But then they get big. This woman actually changed the next year after she did this home purchase. She's now going to be a corporation. You can go over with your either tax preparer, attorney. We can talk a little bit about it, but different structures have different benefits, different tax benefits. And different ways of reporting taxes. It may save you money on your taxes to become a corporation, an S Corp, which is kind of a California corporation, or a limited liability company. Corporations tend to, one of the main differences is to protect you from legal action. So protect you as an individual, right? So there's something that we call the corporate veil, and legal action cannot pierce the corporate veil for one individual who owns that corporation or several individuals, unless it's criminal action, right? So corporations tend to be more protective than limited liability companies in that way. If you have a limited liability company, you can still get sued as an individual, where corporations, you can't. Obviously, if it's criminal, that's different, but there are a lot of differences, and you're going to want to pick the one that's going to work for you.
Can we state that again? I want to make sure people are clear, because there's a lot of folks that think that with an LLC, you cannot get sued.
No, you can get sued.
With a corporation, that protects you legally, but with the LLC, you can still be liable for litigation in certain cases. Can you break that down real quick?
Yeah. So this is a widely held misconception, is that you cannot get sued. Limited liability companies, what that means is that you can only be sued to your ownership interest in the company. It's the limited to your liability in the company. So LLCs are typically formed with one or more people, although you can have a single member LLC where there's only one person. It does not protect you. It does not protect you like a corporation will. I mean, most people do not expect to get sued, obviously, but an LLC does not offer the protection that an S Corp or a Corp can offer. The and the Corp have very slightly different, I'm not going to go into it, but an S Corp functions more like an LLC. In an LLC, you will have a separate tax return. It will not be on your personal tax returns. And you will be issued an earnings statement called a K-1. So a K-1 is kind of akin to a W-2, but it's from your own company, right? And the K-1 will list that bottom line income for the corporation for that year. So let's say you have a negative cash flow. You'll be issued a negative K-1, right? And that will carry over to your personal tax returns, and it may limit your tax liability. It's not good for buying real estate, because negative K-1 means you didn't earn any money. The S Corporation also has a K-1, which is an earnings statement that you or the partners in the corporation will get. A corporation has no K-1. So you will not get an earnings statement from the corporation, although there is a line item in the corporation tax returns where you can, as the owner, take an owner draw or owner salary, but there's no earnings statement that comes to you in a corporation. And you can consult with your attorney, with your tax preparer, on which will be best for your kind of work that you do. But an LLC does not offer protections against lawsuits, tort lawsuits. I'm not talking criminal. None of these offer protection against criminal activity, but they will what we call tort, which is lawsuits for wrongdoings.
Got it. Thank you for clearing that up.
Yeah.
It's definitely you want to know more about misconception. A lot of people think that the LLC offers that kind of protection.
It does not. It's a way for partners to come together with and be only responsible for their ownership interest. So if you have 3 partners and each have a 25%, if you get sued, they can only go after your 25%. That's what it means. It's limited into the liability of the individuals who are part of the corporation. It is not expensive to get either a limited liability, an S Corp, or a corporation. There are companies that will open those for you. Some companies operate in other states. You can talk to your tax preparer about that, but there are, people that do this professionally for a living. They open up these companies for you.
And another thing is that I think is good to look at is the state that you're starting the company in, because different states have different fees that are required annually to upkeep the business. Do you recommend folks starting a company in any particular state if they're wanting that company to hold their real estate specifically?
Okay, so you can use an LLC to hold property. Okay, it's very efficient in holding property. You if you're using an LLC for your business, right, where you're actually, doing business, you may want to look at other options. But an LLC, a lot of people open them to hold property in. Does not protect you from getting sued, but it's just a very easy way for people not to be able to find you. It's not listed publicly anywhere that you own the property. You could do that if you wanted to in another state. You wanted to have an LLC, property holding LLC. You could go ahead and open up an LLC in another state. There may be different tax benefits in different states. If you do that, you want to plan to file a tax return for that LLC in that state, right? And you may also have to, if you get income from it, you may have to file a personal tax return in that state as well as California. So just keep in mind, you want to discuss it with your tax preparer. I am not a CPA or a tax preparer, but I just work with tax returns all the time, so I know. So yes, but once when you're buying residential real estate, you're always the guarantor. So you will personally close the loan in your name. And then once you close the transaction, the purchase transaction, you can quit claim it to your limited liability company or other kinds of vesting that you want to do. Oh, you know what? I cannot.
And you mentioned quit claim.
Yes.
I have heard of a quit claim deed. Can you break that down? Is that when somebody wants to transfer the ownership of a property?
Yes.
Could you explain quit claim? And that's
sure.
QUIT, not quick, but quit claim.
Quit. Yeah, you're
QUIT. Yeah.
So that is the language of title, which we are not going to talk about very much today, but the title rep, when you buy a house, they're responsible for researching the chain of ownership on a property and making sure that no one else can make a claim to ownership. They are also responsible for looking at the actions on title that the prior seller had. They'll go all the way back. And a lot of times people will want to change their vesting. For example, I'll give you a good idea. Me, if I own property in my name, Dana Goodman, but then I opened a trust for my daughter, and I wanted to change the vesting of the ownership to the trust, transfer it to the trust. I would quit claim my name into the trust name, right? I would release my claim and put it in the trust. So that's a very common, we call that an intra-family dissolution, when people are transferring titles into trust, transferring titles to other people. But you can also quit claim your personal ownership into the ownership of an LLC, a trust, a corporation, all of that. But for lending purposes, for residential real estate, that's 1 to 4 units, you do need to close it in your name, and then you can transfer it. That's the document. It's called a quit claim. If I signed it, I would be signing it over, the ownership over to my trust, and I would send that to my title company to record. And when I went next to look up the property profile, it would show it be transferred, quit claimed into my trust. So it's a way to transfer ownership.
Awesome. And could you touch real quick on what is a trust and how you use a trust for real estate? Because I've heard a lot of people talking about buying things in a trust, but then people will also say you need to have a holding company that's owned by the trust, and then your properties are owned in separate LLCs by the holding company that's under the trust. But what is the value of having that trust, and what type of trust do you recommend people look into?
The trust is it's an entity, but it is not technically a business. Okay. A trust is made up as a legal entity, and you can get one. Your attorney can draft. I think they're about $1,200 to open up. And what they do is they have a trustee who manages the trust, and they have beneficiaries in the trust. A lot of times trusts are used for estates. And the reason that they're used is so that a property, when an owner dies, does not have to go to probate. I'm sure you've heard of that term, probate, when a lot of parties have to go to court and decide the disposition of a property because either the owner died without a will or without a trust. If I have a trust and my daughter is the beneficiary for my home, what will happen is while I live, I will be the beneficiary of my own trust. And the trust will state in no uncertain terms that my daughter will be the beneficiary at my death, so that she will be able to do things. The trust should also say what the beneficiaries can and cannot do, right? Sell real estate, refinance, any of the items that are held in the trust. That's why people use trusts a lot of times for residential real estate, is to hold the property for the beneficiaries of the trustee. Now, the trustee is the person who manages the trust. I can be my own trustee, or I can ask someone else to be my trustee. The trust is an actual document. It's usually 30 or 40 pages, and it outlines the terms of how the trust functions, who the beneficiaries are, if the trust can be revoked, and what powers the trustees and the beneficiaries have in that trust. It's a very nimble way to handle real estate. And I like it. For real estate, it can be combined. It can be primary residence. It can be investment properties. It can be other kinds of assets like bank accounts. They can all be within the trust. And all you have to do is, when the current trustee dies, is present the trust to the bank or whoever you're working with, and you have authority as a beneficiary to automatically dispose of the property or whatever the trust allows. If you have someone that dies intestate, that means without a will or without a trust, you're going to probate court, which can take 24 months. You don't have access to it. Another thing a trust can do is, in the state of California, limit the amount of inheritance taxes. And I don't want to quote how much, but beneficiary inheritance taxes are huge. They typically are applied when the dollar amount is over a certain amount of money, but it can limit or mitigate your inheritance taxes because there are none when you're a beneficiary.
That's good.
So they're great. Research, you can look up real estate trusts. They're great for holdings. They are an excellent investment for the money. I think we have a legal document preparer called We the People. Have you heard of that? They're kind of they are a company, and they do trusts, they do divorce, they do without having to hire an attorney. They have like paralegals who are certified. They can help you prepare a trust for half the price of an attorney.
And
it's called
We the People.
People. Yeah, I think there are them for all over the place, and you can get a trust, you can get a corporation from them, you can work with them, and it's cheaper than hiring an attorney. Although I do recommend, the problem with getting an attorney, especially a real estate attorney, is if you're not, and I find this is just terrible, but if you're not going to be a big dollar client, it's hard for them to make their business out of doing small jobs, especially for attorneys. So I like to use paralegals. Paralegals are not allowed to give legal advice. I happen to be a paralegal, but they do report and work with attorneys. They do understand how the process is. I don't work as a paralegal, by the way, but they are very helpful for that purpose, and that's what they do at We the People. Or they're what's called licensed document preparers. They can help you prepare your paperwork so it's not so crazy and confusing. They can do trusts or LLCs or anything you might need.
That's awesome. So folks, if you're looking to start your business, or you have a business and you need some help on the legal side, on the structuring side, on the entity formation side, look for a paralegal. Look into We the People. This is not sponsored. We're just sharing good information. But that's a great resource, because a lot of folks think, oh, I got to save enough money for attorney fees. Then I got to pay these LLC fees. And then there's monthly upkeep for the LLC. And it's like, do your research and due diligence. You may not need to pay all those fees. You may need to have a completely different structure for what you want, but always consult the people who may be able to help you and have the knowledge and expertise in that area. And that's where we would consult you to look at We the People or another paralegal service that can provide you with some good info and details on how to do what you want to do for your specific situation.
Yeah, and you want to do it right. Again, You do, consult and see which business structure is right for you. We would just use the income from whatever business structure you end up using as your, we're still using that net income. So it doesn't matter if it's a K1 or line 29 from the Schedule C for sole proprietor. For us, as far as lending is concerned, conventional lending, we will use those numbers. We're just going to wrap up on this. Is just these are kind of the important, really good, solid information. One is to live within your means. I know it's really hard. I've had trouble with that. Credit is so readily available. Try to live within your means. Get credit counseling if you need it, although I don't really think it's necessary. If you keep your balances low, pay off your debt, don't spend too much, you won't need credit counseling. I mean, credit counseling is just someone who's going to tell you, what you need to pay when you really should know what you need to pay. Pay your bills on time. Try to pay off your debt. If you can't, especially your student loans, do not default on your student loans. Make those payments. If you default on student loans, you may not be able to get an FHA or other kind of government loan. So please, make sure that you acquire and pay your student loans. It's your responsibility to know when those loans come out of deferment, and to start paying them. Check the loan servicing online often so that you know when those loans are coming out. A lot of people didn't know. I know last August some loans came due. Make sure you understand. Use a secured credit card, check your credit. There's a bunch of free credit. You get a free credit report from Experian, know where you stand, Credit Karma. I didn't mention this, but you can also, utilities are not reported on the credit report, but you can report your own utilities to kind of help boost your score. It's called Experian Boost. You can sign up for it. Obviously, if you do that, you want to make sure you pay your utilities on time. So don't invite that unless you're probably going to do it. And I wanted to talk about this because this is the one thing that I see all the time that people is going to deeply impact their purchase because their monthly debt is too high. But there's a hint right here. What is it? What do you think it is? There's a hint.
Credit repair?
Huh?
I don't know. The one thing most likely to impact your purchase power.
Yeah. It's right there. That photo.
Having a car?
Having too expensive of a car.
Oh.
Okay. So I know that it's very, very easy to go out and have a humongous car payment. And they'll give you that credit too. They'll give it to you. And you're making $45,000 a year and you're driving a car for $750 a month. That's too much car. I'm going to be the mother here and say that's too much car for you. If you're not making six figures, if you're not making $100,000 a year, you should not be driving a $750 a month car when you're trying to buy a house.
How should people be thinking about their income level versus the amount of debt they could take on with a car? Is it like a formula or like?
I mean, how do you think about that? We're looking at that 50% rule, right? So that's the rule. So I can go to 56% with FHA, but look at how much that car, let's say your monthly income is $2,000 and you have $1,000 in car payment, right? You only have $1,000 left over for all your other debt, including taxes, insurance, all of that. So they can call me. I'll do the numbers for them, but that's the 50 to 56%, including your car payment, the mortgage, taxes, and insurance, can be only 50 to 56% of your income. $750 car payment is a lot. A lot of people are exceeding what they can afford if they want to buy a house. There are ways to deal with that, which is trade it in. We cannot pay off leases to qualify because car leases beget other car leases. Obviously, it's not a purchase, so we can't offer the solution. Well, hey, if you have a purchase on a car and you're under 10 months, we can omit the car, but not a lease because we know that you're going to go out and buy another one. So a lease does not offer the same flexibility. So this is some of our challenge: affordability in Southern California, stagnant wages, ability to save, cost of living, increasing debt, and low inventory. But if you keep your debt low and don't buy too expensive of a car, then I think it's possible. How are we doing on time?
We're good. I think
Okay.
we're like just over an hour in, but this is great. We need all this information. Our
Okay.
listeners need this. Our listeners need this. This is so good. Thank you, Dana.
So I want to just talk about a little bit about what constitutes a mortgage payment is principal and interest, property taxes, homeowners insurance. And if you put less than 20% down, you'll have to have mortgage insurance, which is a separate payment that's included in your payment. And then if you have a condo, we don't collect and pay the homeowner's dues, but we did put it in your liabilities. So if you have home association dues of $440 a month, we will add that to your liability, but we don't collect that as part of your payment. You pay that yourself.
And that's HOA, homeowners
HOA,
association.
yeah. So
Have you
if
seen
you're
that
looking at
impact? Have you seen the HOA impact somebody's ability to close or like get a house
yes,
because maybe the
yes,
HOA just set them above the threshold?
yep. So what we do is if you know you're going to buy a condo and you want to get pre-qualified, what I'll do is I'll put in a buffer. So I'll estimate what the HOA will be based on the price of the property, and I'll stick it in there so that we have that placeholder there. And for my pre-qual, I'll tell your real estate agent that you can qualify for this amount with no more than X dollars HOA. But usually it was case by case. So if you find something you want to call me and see if it works, we will. I'm not going to let you enter into contract if your HOA blows the deal. We just can't have that happen. So we do, if you're going to look for a condo, then we will ask you, what I'll estimate for you. So I wanted to put up a summary of a transaction right now and talk about where we were with rates. Rates are about 6.5 right now. They are not as good as they were, and they're going to stay this way for a while. Interest rates for homes are based on the 10-year Treasury bond. It's a mortgage-backed security that is traded on Wall Street. It is not based on the federal overnight rate. So when you hear someone say the Fed is raising the rate that the Fed is raising is called the overnight rate, which is the rate at which banks borrow money from the federal government to cover their balance sheets. So it's basically banks' cost for money that is passed down to you. So it will have some impact on the mortgage-backed securities and the interest rate. But the overnight rate is not the federal government does not set mortgage rates. They just set the rate at which banks borrow money. Banks do not have enough money on hand to cover their balance sheets every night because they take the money that you give them and they go on and invest that. So that to guarantee the money, they borrow it from the central bank. This is the way the financial system worked. And the central bank charges them interest rate on borrowing this money overnight. And when banks have an increase in that rate, that will trickle down into a mortgage rate. Let's look at a purchase price. This is a condo for $395. I'm going to estimate my closing costs with my down payment and everything to be about $20,000. So the total cost is $415,000. I'm estimating that the cash the borrower will have to bring in for this primary residence purchase is $27,000.
That's at 6.5%, right?
At 6.5%. Now, I can get down payment assistance to help with a lot of that cost. The borrower still definitely will have to bring in money, but I really not want to talk about this here, but I want to talk about the estimated monthly payment. So you're going to see the principal and interest is $24.51.44 at 6.5. That's the principal and interest. You should understand that when you have a 30-year mortgage, which is what this is, you will not pay principal for a long time. You really start out by paying the interest, mostly the interest. Then as the years go by, you start including principal. One of the ways that you can also pay principal down faster is to include a principal payment with your main payment that is going right to the principal. So the less principal you have, the less interest you pay. We can get into that a little bit more on a more sort of nuts and bolts home buyer seminar. I wanted to kind of get through this payment. Home insurance, we estimate at $70. The home insurance covers anything from the walls in on a condo. So we're not talking about the outside common areas, but we are talking about what's in your house, right? You'll be required to carry homeowners insurance. Real estate taxes are set by the county that you live in, and we estimate what those real estate taxes will be. You are not going to pay the same as the seller. The new guy coming in is going to pay a new assessment for the value of the property. If you're the buyer, the county will come out within about 6 months of your purchase and they will assess your rate. We estimate the rate to be 1.25% times the purchase price. That's ubiquitous, standard in California. All the lenders use the same, but it may not actually be that. It may be more, but that is our estimate that we use. Mortgage insurance you must carry. This is an estimate for FHA mortgage insurance, but if you have a conventional loan, a mortgage insurance is based on your FICO. Again, the FICO comes into play. It may be less than that. Mortgage insurance is what's paid when you put less than 20% down to guarantee the lender against your default. It's not like a policy, but it's more like an indemnification that will protect the lender. And there you see the HOA dues at $375 for this condo. Although you're not going to pay that with your payment, so you'll end up paying about $3,100 on your base payment. This is what a condo looks like right now.
Wow.
Yeah.
There's a lot to it, and there's a lot for people to consider.
Yeah.
And there's also a lot of variables that are kind of unknown. Like you mentioned, the insurance would kind of get determined later. So like in that 6 months, while the city or the county is assessing our taxes, are we not paying anything, or
No,
is it prorated? Or
yeah. So if you put less than 20% down, generally you have to have the servicer, the loan servicer will collect your insurance and your property taxes. In California, property taxes are paid twice a year. And we'll go ahead and collect this and pay it. And then within 6 months, you'll get a letter from the property taxes that said there may be some residual that they collect from you. It's generally an accurate, but you will get something called a supplemental tax bill. And there may be a difference between what was collected and what you owe. So you may end up having to pay that. Or if there's some sort of special measure or bond that's voted on by the people that live in your county and they decide to pass this measure for schools or whatever, and there's a special tax, the lender does not collect that. They only collect your base property taxes, and you will be responsible for any supplemental taxes. But generally, it's pretty accurate. When a lender collects your property taxes for you with your payment, they have a fiduciary responsibility to pay those taxes on time, and they do. And they also will audit your tax account once a year. There cannot be too much or too little excess in there. So it's very highly regulated in terms of what we call an impound account. Impound is when your taxes are and homeowners insurance are collected and paid on your behalf by the lender. Homeowners insurance is collected once a year. So you will pay an entire year premium at the closing, and with your very first payment, you'll pay 1/12 of the premium so that in 12 months, the lender will have enough to renew your home insurance.
okay.
Yeah. Again, this is kind of part of another more in detail home buying sort of presentation that we can do so that we can really get clarity on what these costs are. We'll go over what closing costs are and the difference between closing costs and down payment. I did want to do this for you guys because I know so many people come to me all the time and ask for what is the difference between primary and investment? Bijan, you and I met at the Real Estate Investors Association. And the reason that I came there was because I just realized so many people want to buy investment properties. They just don't know anything about it. So I just kind of wanted to go through this really quickly so that we would understand the difference between the two. And I'm going to first start by talking about occupancy fraud. It is a real thing. And lenders, the FBI, HUD, they all work very hard to discourage occupancy fraud. Occupancy fraud is when you say that you're going to live in the property and you don't live in the property. That is not your intent to live in the property, that you are going to use a primary residence interest rate and low down to purchase an investment property. against the law and they don't like it. They can, a lot of people do it, but they can unwind your loan. They can call your loan due and payable if they find out. It's unlikely they'll find out, but it's all about what your intent is to occupy. FHA is more strict on intent to occupy than Fannie Mae, 3% down. But Fannie Mae is unlikely to knock on your door, but FHA will if they suspect that you do not live there. And so the reason people do it is because purchasing a primary residence does not have these tremendous down payments and other restrictive guidelines. There is no low down payment for investment. So primary residence is anywhere from 3 to 5% down minimum. Investment is 20% down or more, depending on how many units. You're not going to live there. I'm talking about conventional financing. I do have some financing at a very high interest rate where you can put 10% down, but may have other difficult requirements that are not appropriate for like a first time investor. It's just not, it's not going to be a good loan for you.
Yeah.
Anything over 4 units, like a multifamily, is what we consider commercial. Okay. Commercial is anything over 4 units. And commercial is a whole different animal. I do commercial in California. It requires substantial reserves, down payment, experience, personal financial statement, a lot of financial savvy. Okay, it's not an easy loan. I would not recommend a commercial loan for someone who's, trying to get into the game for the first time. Those are people that own 15-unit apartment buildings. You can kind of work up to that. But it is a different kind of loan. Investment property financing may require landlord experience, okay, to be able to use the net rent to offset your payment, right? So there's a rule that says that we can use 75% of the market, gross market rent, and we will have an appraiser tell us what they think that is. And we can add that back to your income. Let's say 75% of it $750. We can add that back to your income to help offset your payment. But Fannie Mae does not allow us to add that back to your income if you do not have a housing payment, right? So let's say you live with your folks, right? They are not going to permit us to use that offset. Freddie Mac is more liberal with that, but you either have to have a housing payment, like you're paying your apartment rent, or you have to, or you own a house, and you typically have to have a 1 year, 12 months landlord experience to use that offset income on Fannie Mae. Otherwise, and most people, that's how they are able to buy, is because they can use that offset rental income, the potential rental income from the unit. It depends on which program we use, but I wanted to say that some conventional property financing does require that experience. A lot of people go, oh, the rents are $2,800 and that's going to cancel out the payment. That's just not the way we do it. And it's not done at any bank that way. You are going to use a 75% of gross rents that is told to us either by the rent roll or by the appraiser who appraises the property so that we have an idea of market rent. You cannot use the whole thing. It doesn't cancel it out. It's just added, a very small percentage of it is added back to your income. If you live in the property and you have 4 units, we will only use gross rent of 75% of the gross rent of the 3 remaining units. Okay, you do not get to use the rent from your own unit. So right. It's generally smaller than people expect, right? Because it's generally not canceling out the mortgage payment.
Okay.
Investment property can require up to 6 months PITI reserves per unit. Okay, and that's depending on what Fannie Mae, the automated underwriting system, tells us. So PITI was principal, interest, taxes, insurance, and mortgage insurance, and HOA. So let's say this, for example, $3,481. You could need up to $18,000 to $20,000 in reserves to buy this condo as an investment property if it required 6 months reserve. Sometimes it only requires 3, but usually with an investment property, you will have to have some reserves somewhere. And this is why I tell people to if you're working a W-2 job, just start a 401k. Start it. We can show it as your reserves. You don't have to have it liquid in your account. We can use stocks, and everyone should have a 401k because it's a very fast growing way to earn that reserve money. You don't have to spend that money. You just have to show that you have it.
Gotcha.
You cannot use gift funds to purchase an investment property. It's all got to come from you. That's just another thing. And same with reserves. They have to be seasoned in your bank account for 60 days.
And if somebody did want to give you a gift, or if you had like a partner, a cash partner, you don't have to call that a gift. But if you wanted to use any of those funds, that would have to be seasoned, which means sitting in your bank account for a period of time, just to show that it didn't come from out of nowhere. It wasn't just a direct deposit from somebody. You have to kind of basically prove to the bank from an account perspective that you've owned that money for a period of time, right? That's what seasoned means.
Yeah, seasoned means that it's been sitting, we call it seasoned or sourced. So it can sit in your bank account for 60 days, where as long as we have those two bank statements, each covering 30 days, but it doesn't show the deposit, right? So it's just got to be exist there.
Okay.
It cannot be, we cannot paper trail that for investment back to a buddy, right? So they would look at your bank statement and want to know where that money came from. If it was a deposit, if it was already just sitting there, it's considered seasoned. If it's been in there for 60 days, for primary residence, we can get a gift letter, but you are not allowed gift for investor. So you have to freely own that money. It has to be sitting in your account for 60 days, or you can invite the gift donor to become a co-borrower on the loan, and they can bring that money in as a borrower. So yes, you will have to, and that's the same with all money that you use in a real estate transaction. You cannot use mattress money. You cannot bring that money that's sitting in your closet or wherever, unless it's been seasoned or sourced. Sourced means I got a bonus at work and they gave me a check, or my grandma gave me this money. We're going to paper trail that. We do not want to see cash and use. It's not really permitted in real estate transactions where there's financing. It's an anti-money laundering law, and we all follow it. It's the same everywhere. But there are ways to kind of work around it, but not for investment property. It cannot be a gift. Okay, so higher down payment, higher interest rates for units and investment properties in general. Like I said, there are other ways to go about it. You can go hard money, which is where they don't have a strict requirements, but they will have a phenomenally expensive interest rate. They usually are interest-only loans with lots of points. Be prepared to pay 4% of the loan amount as a compensation to the loan officer. We don't operate that way. You're never going to pay me any compensation. I'm paid by the bank. So it's private money, and conventional lending is very different. But there are options for private money. I don't recommend it for a buyer who's starting out.
Okay. So there's private money, there's bank money, there's conventional loans, there's private loans, there's hard money loans.
Yeah.
And okay. So
I can set someone up with a private money loan. I just don't feel good about it. It's just not a great vehicle for a first-time buyer. They're very, very expensive. They require a lot of cash. I think the reason that I'm so big on conventional lending is that, and I want to say that if you have not bought anything, you should buy your primary residence first using primary residence terms, and then turn around and sell that in a couple of years and use the equity to buy a new primary residence and make your old residence your investment.
Oh. Okay. And with a lot of these, if you live in the primary residence, your first one for 1 year, you can sell it after that, right? 1 year is the minimum.
You can sell it in 6 months.
Oh, in 6 months.
Okay. But you're not going to earn the equity. You want to obviously hang on to it until you have some equity, because once you have equity, you can turn around and buy something else. Equity means the amount of money that you've earned. So if you only borrowed $300,000, but your house is now worth $500,000, at closing, you will get $200,000.
For that
minus
equity.
Because you earn that equity. But what you can also do is use the primary as your departure residence and buy a new primary with same low down and low interest rate terms and make your departure residence your investment property. They don't care. There's no changes on the loan. You'll have a great investment property at a very low rate,
Now,
which
what if you did a FHA or a NACA loan? Does that change?
uh, FHA, you have to intend to occupy within 60 days. You have to keep the loan. Any conventional loan you want to keep for 6 payments or more. It doesn't change. You can depart an FHA. You can have an FHA loan on your primary residence, but you cannot use another FHA loan to buy the new one. You would have to use a conventional loan, except for certain circumstances. You can have two FHA houses, but it has to do with like outgrowing your old house and all this proof. Like I had a lady who had 5 kids since she bought her FHA house, so we were allowed to buy another FHA house, but
Okay.
typically you cannot. But I'll work with that. I mean, I'll tell you what you need to do. But
And
for NACA, so a lot of the programs, NACA is just one program. They do have requirements about how long you have to live there, what you're going to owe. So if someone like NACA or LIPA is another program we use, they give you $140,000 to buy your house. You're going to owe that back to them. So it's not a grant. It's not a gift. That will eat into your equity in the future. It's better, I think, to buy low down and then just grow the equity that remains your own. They're great programs, but you're going to have to pay that money back. It's not free money, and they may have. I don't work with NACA, but you may have restrictions about how long you have to own it, when you can sell it, or maybe profit sharing. I don't know what's involved in it, but
yeah, I think I heard with NACA there had to be a number of years, and I heard with
yeah,
FHA you had to live there for at least 1 year before you could sell it and roll over and get a new loan.
you can
But with
sell
NACA, I
it
think it
any
was like 4 years.
FHA 6 months. I mean, but you want to keep it in there so that you can get your equity.
Right.
You don't want to sell it right away.
Unless there's certain market conditions, like if you're in a market condition where 1 year later your property is worth $200,000 more than it was, or 100 because some crazy appreciation or just a shift in the market, would that still be a good idea, or would you say, hey, keep holding
Uh,
it because maybe you'll get more equity
well,
if you just hold on longer?
I had a guy that I work with who and his family who was a home who worked with Homeboy Industries, and the only place that he could afford to buy was like Crestview, which is near Lake Arrowhead. This is a number of years ago, and I think he bought a house for $325,000 in 20 months. It was worth $535,000 in 20 months, so it's less than 2 years. And we just did a new loan and he pulled money out of it. He pulled $100,000 out, and he actually decided to upgrade his house, but he could have gone and bought another property with that equity if he wanted to and use
And that was a cash out refinance that you did?
Yes. So
Okay.
you can pull your equity out. You can leave it. I would just leave it. But there's always a lot of appreciation in Southern California. It's not appreciating as fast as before, but I'm going to just talk about briefly. I'm just going to go over if you want to afford a home in Southern California, there are some ways to start. One is manufactured housing. They're much nicer now. We don't finance like a single wide. Everything has to be a double wide condo or starter home. You can get a co-borrower. Sometimes, a lot of people are working remotely, so they can move out of Southern California and still retain their jobs. Riverside and San Bernardino counties are great for purchasing. You can sometimes use your 401k. Here's that 401k again. If you have a retirement plan, a lot of times they let you borrow from it at at very little cost, and you can take a chunk out and use it for the down payment. Obviously, you want to pay down debt. The more debt you pay down, the more you can qualify for. There is an equity incentive that when you buy here, you're obviously going to earn that equity no matter what. And it makes financial sense to own a home. I just wanted to kind of work through that. That's some ways to afford as co-borrower, co-living. There's lots of opportunities there. We kind of talked about this, so I'm not going to talk about this too much, but these are the minimum downs for some kinds of loans. And I'm kind of wrap up my presentation, but I do want to talk about financial fitness and savings mindset because financial fitness is really a habit. It's not a skill. So when you get into the habit of paying your bills every month, like I wasn't really shown really good spending habits growing up. If you weren't, you wouldn't forgive your parents and start learning it today. Because I notice a lot of people that I work with sometimes uh, it's not that they can't afford it, they just won't do it. Like I'll work with someone and work with them, and then they'll all of a sudden they'll get a late payment. I'm like, why did you let that happen? You can
Right.
just go back to the starting. This is really a running the business of your personal and professional life, and
And
you
these are
want
like the
to.
basics. Like these are some of the core basics. And I will admit, I learned the core basics from my mom and dad of paying on time. They did teach me a basic level about credit, but it was more about being aware of the dangers of misusing credit, as opposed to how can I use credit to get a house or finance my business and then use that money to like pay for ads and then pay them back and then grow my business. It was more about holding on to everything. And I understand that the skill is important, but I love the framework and the mindset around why it's important to do these things and how it actually can create wealth. And then when we do have some funds or some savings, a deployable strategy to go ahead and grow that wealth and not just be sitting on cash, not knowing what to do with it other than use it to buy something, right? So
Yeah, like
so
I
this
got it.
this
We're
mindset
very.
matched with the investing mindset is so important.
Yes, it's a very commercial. We live in a very commercial environment, and there's a lot of temptation everywhere. And that's one of the great things about a 401k is that it'll come out of your paycheck if you're a W-2 employee. My company matches. I'm on a 4% match, so they'll match everything that I give, and I give a huge amount. I give almost 20% of my income into my 401k because I don't want to have to go and like put money into the bank. I really like get taken out before I get it. So a 401k is a great way to in 6 months you will have, if you commit to it, you could have a little egg in there, and that you can show that for your reserves if you need it. Um, and another thing I want to say is you can forgive your past. Like I felt so guilty for such a long time. Forgiveness is really important. Self-forgiveness. You can learn from your past mistakes, and also your credit is not something like you don't ruin your life because you have a period of bad credit. You know what I mean? You can rebuild it, and it's one of the things in life that we can. When we make a mistake, we can get it back. And the last thing I want to say, there's a few things on here, but make yourself accountable to someone else. If you got a buddy and you want to get together once a month and sit down and pay your bills together, I make it a habit of paying my bills around the first of every month. I sit down, it's on my calendar it, make yourself accountable to yourself or another friend so that at least once a month you're reviewing your spending, you're reviewing what you owe and what's gone into savings. That's just really important to make time for yourself. I used to hate going in and seeing what my bank balance was because I didn't like it. But it's your friend, it's your friend. Don't ignore it. Keep track of what you're doing, and check in on yourself. And I just want to finish up because I want to talk a little bit about Warren Buffett. Warren Buffett is the CEO of Berkshire Hathaway. I'm sure a lot of you know who he is. He lives in Omaha, Nebraska, and his company Berkshire Hathaway buys other companies, turns them around, and sells them. And he has a personal fortune of $100 billion, and he's just kind of like a guy, you know. He has donated most of his wealth to the Bill and Melinda Gates Foundation. If you don't know who he is, he has an absolutely fascinating story if you want to look him up. But I want to tell you something about Warren. So $100 billion. So this is the house that Warren bought in Omaha, Nebraska, when he first opened Berkshire Hathaway. And guess what his house looks like now?
Same house.
Same house. This is his house. Now, I do think that he put up a fence
Right.
because
At this point.
it was a little bit of a privacy issue, but this is kind of the same modest house that he lives in. And this down here is his caddy. He does lease a Cadillac. It's $750 a month. Remember, I talked about the Cadillac. And he says that's his indulgence. He allows himself to lease a Cadillac. I think he leases it for 2 or 3 years and then turns it in. Um, and Warren always says, "Do not save what is." I can't read what it says. Do not
Do
do
not
not
save
save
what
what
is
is
left
left.
after
Yes,
spending, but spend what is left after saving. Do
yes,
not
yes,
save what is left after spending, but spend what is left after saving.
yes. And if you see here, he also says, if you buy things you do not need, soon you will have to sell things that you do need.
Wow.
So that those are his two things, and I just want to tell a little story about him. So this is Warren, and he loves McDonald's. That's one of his favorite places to eat in Omaha.
And he's also an
And
investor in McDonald's, right?
I think Berkshire does own some of McDonald's, but he really likes McDonald's. That's why he goes there. So in the morning, his wife will give him change, for his little cup in his car for him to buy either a sausage muffin or an egg McMuffin. And the way that he decides what he's going to eat is he looks at the Berkshire Hathaway stock for that day. If the Berkshire Hathaway stock is up, he gets himself an egg McMuffin, which is, of course, more bougie than the sausage McMuffin, which is 99 cents. If it is not a good Berkshire Hathaway stock day, he only gets a sausage McMuffin. So that is how Warren thinks about breakfast. $100 billion and drives. He can go ahead and drive that $750 a month Cadillac. I think it's worth it for him because that's all he does.
Right.
That's his sort of thing. So look at Warren. He's a wonderful role model for people who he did not start with a lot of money, but he said, I just loved watching the interest grow from the equity in my stocks that I bought, even if they were not very expensive. He's got just wonderful stories about his life. This is me. So if you want to find out where you stand, if you're interested in getting a mortgage, you can contact me here or through Bijan. And, there's so much more to tell. We'll have to do more of this, more of the kind of nuts and bolts of home buying. But this has just been great talking to you. I just didn't want to drag on, but we'll
Well,
do
this is really good. I think this
another.
might be one of the most educational and informative episodes of Abundance Universe. I want to thank you for taking the time to share this and taking the time to educate yourself so that you could be a resource and a tool and a light for others because you help so many people both through Wintrust Mortgage, but you also do workshops and seminars and talks for people of all ages, all over the country, all over the world. So I just want to thank you for being abundant. And there's a couple questions that I ask everybody that come on the show. So I'll ask you, and then we can get ready to wrap it up. But I want to know what would you say is your advice for someone who is looking to create more abundance in their own life personally? Maybe there was a time when you weren't as abundant as you are now. What did you do to turn your life around from like a mindset and just a habits perspective to create more abundance in your life?
Well, I think it was discipline for me. Honestly, I really focused on moving forward. I know that I could feel stagnant in my life at some times where I just wasn't achieving it, but I really made it achieving more like a job, right? So I would I would time block some time every day, a number of hours. I would try to plot out a course for myself. I know I'm being kind of general, but there were times where I felt like really stuck. Like I didn't know what I was going to do next in my life. And I felt like I had to block time out, do research and online. I had to do like a board of my interests, write that down, really just, very starting at the very basic. But I think the most important thing was giving myself that time to work on it. Our day gets very busy. If you're having a problem, if you're feeling stuck, if you want more abundance, you must donate the time to think about how to get there. Because I realized I was just thinking about, boy, I wish I was there. I wish I was there. But I wasn't giving it the time that it needed. So I would say that would be definitely bringing more abundance is set aside some time for yourself to exercise your brain on how you're going to move forward.
Wow, that's good. Okay. Thank you for that. We got to
My
give
pleasure.
ourselves the time. Like I feel like sometimes we can get so caught up in the business of life and doing things for others that we can forget what's important to us. And I think we got to check in with ourselves. And there's a term that I like to talk about all the time that I discovered a few years ago called ikigai. Ikigai, and
I
it's
gotta
a
write that
Japanese
down.
term. Yeah, ikigai, and your ikigai is your reason for being. It's basically your purpose, your big why. And I discovered that my ikigai was the We Uplift the World Foundation, but basically to use my gifts of creation and use my voice, my ability to generate excitement and community and have fun, use that for something bigger than myself, which is this organization that I created for art and tech education called the We Uplift the World Foundation. But that was a process of me going through and seeing what was the most important things that I loved, my skills, what I was good at, also what does the world need and what's the demand in the world right now? What is the market looking for? I put all that together and created this offering. And I think it's important for folks to really understand who they are and what is the best way for them to serve the world. But all that is so much easier to do when you have the basic financial stability in place and the basic knowledge of, okay, I'm growing my wealth. I have income. I have investments. I know where I'm going to live. I own where I'm going to live. That makes finding your purpose or creating a big business or a company or a big mission so much easier when you cover the things that you shared with us. So I want to ask you as well before we wrap it up, what is your why?
Oh, well, I would say my daughter is my why. When I had my daughter, I mean, she became just a driving force in my life. And I will also say that since she's kind of moved away from home and going to college, I had to find a different why because, she was no longer as dependent. So I would say my why is me. I want to move myself ahead. There's a life that I want to live for. I really do. I'm really happy in my life. I can do the things that I love to do. I am not a millionaire. I'd like to be, but I have abundance enough and I'm not worried about where my bills are getting paid because I, organized it in such a way and I have goals that I want to achieve. So my why is really me and what the next part of my life looks like. And it's really because I spent the time and I invested the time because with child rearing and being a parent, you're always so involved in them. And it was really kind of taking time out and kind of looking. So I would say her and me together are my wives.
That's excellent. Well, you're doing it and you're helping a lot more people. You're leaving a really awesome legacy of education, inspiration, helping people with financial freedom, financial stability, which is transforming their lives for generations and generations. So, really grateful that your daughter and you are able to provide that inspiration and motivation for you to do what you do.
Yeah, and I want to say also as oops my I just want to say so also it doesn't have to be like a giant. You'll feel better too. I mean, you'll feel better. It doesn't have to be today doesn't have to be you're not moving the big pieces. Maybe you're just starting out by sitting down and going over what your bills are going to be for next month. It can be just very small basic thing. You will walk around, you'll feel so much better about yourself that you took the time and the responsibility, or even like checking your bank balance, seeing where things are at, checking in with yourself financially. Just make 5 minutes a day and just check in with yourself. And you're just going to walk around and you're going to feel great.
Yes, it definitely does provide a level of confidence and security just to know where we stand every
Yes.
day. And I've gotten in the
Yep.
habit of checking my bank accounts and my investment accounts each day as soon as I
That's
wake
right.
up, just to level set. And it actually will help transform what I decide to do with my day. And I actually have more productive days because that is a driver,
Yeah.
not just to increase it, but to maintain it and to let me manage this well. And I enjoy taking care of the finances that we're able to create because it is a creation. Making money is an
Yes.
art. Providing value to others and receiving money in return, that's an art. That's an art form. And the result of that money, that's a creation, right? So
Yep.
that has to be fostered and nurtured as well. So you've given us some good tools and tips to do that. And lastly, before we wrap up, I just want to know if there are any advice, recommendations, or tips that you want to share that we haven't discussed yet that you would want to leave to somebody if this was the last podcast they ever listened to. What would be kind of the final things you want them to like really remember and take away? Um, and it can be about anything, but just anything else you want to share. Let's give it to them. Let this be the
Okay.
best
Well,
podcast ever for them.
I would first say get advanced training. So either college or vocational school or lots of online courses. There are lots of advanced. I think getting that education, extending your education is so important for just in personal wealth. and stability. I am a big proponent of secondary education. It doesn't have to be college, it can be vocational school, and you can get it paid for. There are ways, but that will put you into a whole nother income earning bracket. You're just going to be taken more seriously. It's so important to me that people get out of high school and they go and they pursue that. You may not be, you're still kind of forming, you're going to have that guidance. It's going to be great for you because career readiness is very important. And I don't think sometimes high school doesn't prepare you for career readiness. And so I would say definitely get that education that you need. Go out and get it if you need it, because that's going to just put you in so much better of a situation. So that, I'm going to just end with that, because I think it's so important to have the skills that you need to go out and make it. And there's a maturing that comes after high school when you are in that secondary education situation. It has nothing to do with academics or anything. You're not going to remember anything you learn in college anyway, but you will mature, and you will feel ready, and you will have peers that support you. And I think that would be maybe my number 2 is get peers that support you, get into a group, reach out to people. Do not do this in isolation. It's very hard to be a creative or run your own business in isolation. Get into some support groups and work with people who are like-minded, because then that will help you, during the difficult times. It's not always easy, especially for young people. There are lots of groups available. Even our Los Angeles Real Estate Investors group that meets on the second Thursday of every month at the Main Cultural Center. Get out there. Do not stay home behind the screen all the time. Get out there and be in your community.
Yes.
So I could keep going, but I would say those are 2 awesome things to do. Don't stay home and just be your screen. Get out there and do some volunteer work, meet people, because that will expand your business. I'm going to like 10 or 15 events every single month, because it helps my personal growth and it helps expand my business, and it gives me experience on how to have conversations with people, especially when, you graduate from high school. You might not be totally socially ready. You have to, there's no learning manual. Having conversations with people is important. And especially if you're going to be an entrepreneur, especially if you're creative,
right.
You've got to be able to interact with a lot of people. So anyway, I could just go on and on, but I would say education and outreach into your community. Stop staying home.
Get outside.
Get out.
Get outside. Talk to people. TTP.
Do something.
Network. Collaborate. That's good advice. I love those 2 points. Folks got to go for it. Folks got to live their best life. You got to believe in yourself, but you definitely got to connect with people. Like, all the opportunities that are going to happen for you are going to happen from other people that see value in you and that you provide value to and receive value from. This is how Dana and I met at the real estate investors meeting, and just having an organic, real conversation. We saw we had so much in common, and now we're coming together to have a conversation that can uplift and benefit you. And this is how we uplift the world. This is what it's all about.
Yeah. I'll tell you something. They told me when I first started in the loan industry, I would like sit in my office all day. And one time my boss came in, he's like, there are no loans in the office. You have to go out. You have to leave to generate your business. And that's going to be true for just about anybody. You really have to get out. Stop staying home.
Yes. Get active. And I want people to understand too, money does not just come out of thin air. Money comes from other people as a result of providing value to those other people. So let's get out and meet some people that we can provide value to.
Yes, I agree.
This is awesome. Well, Dana, I have thoroughly enjoyed this conversation.
Me too.
A lot of takeaways, a lot of really great notes. I'm going to go back and watch this again and again and take my notebook out, because you gave us a college course on investing.
It was a lot. I'm sorry. It was a little rambling, but
don't be sorry. No, thank you. Thank you for this. This is what we need. This is what Abundance Universe is all about. As you mentioned, education is the key to progress. Education is the key to breaking through new paradigms. And we have to be supporting each other with knowledge and wisdom that has helped us. And that's what community is all about. So I just want to thank you. I'm immensely grateful, because the listeners of this podcast are going to have some special gifts that they can use to really uplift their life. So thank you for sharing all that you did. I want folks to Make sure you're subscribed to Dana Goodman. Check out her socials. I'll be tagging all of her stuff in the show notes. But Wintrust, that is her company. Dana Goodman is her name. Look her up, reach out to her, connect on LinkedIn. Make sure if you're getting a home or you're interested in getting a home, you give Dana a call. She's going to get you set up with the right mortgage product for you and make sure that you're getting the best deals and have the most support, as you can see. So reach out to Dana, let her know any questions you have, let her know what you thought about the show, and let me know if you have any questions or what your favorite discussion topic was today, because I know we covered a lot.
Yeah, we can do another one.
We will. We're gonna have
Okay.
to. So let's see what the people say in the comments, and then we'll follow up with whatever the audience is hungry for. Okay. So thank
That
y'all for
sounds
tuning
cool.
in. Dana, thank you. We want to
My
tell
pleasure.
all of our listeners to have the most abundant day every day. Take action on the things that you learn. Go get in community. Share this with someone that you love and that you care about, and connect with us on social media. Until next time, peace and blessings abundantly. This has been Abundance Universe, Bijan and Dana Goodman. Thank you.